Welcome to our Friday investment talk. This is the talk that we do every Friday between partners, Alan McGregor, Christopher Davis, Michael Berry, and myself, Veronika Tishkova. And we would send out the recordings of this talk to all our clients and all our investors. You can find them on our AVC blog, so please get the access. And also, I would like to draw your attention to the other articles you can find there that you might find useful. Also, we do webinars on the regular basis in Russian every other Wednesday, where we talk for an hour about different topics that clients and investors and consultants would suggest. For example, the last time we discussed dividend ETFs, before we were discussing just dividend strategies. And that was the topic that our investors, our clients suggested. And that kind of brought up a lot of more ideas and more topics for future discussions. So if you'd like to receive those recordings or wanna watch them in Russian, please again subscribe. We also have different articles in Russian that our consultants have different opinions on the current situation, so they post their own articles, which are quite interesting to review. And I would like also to draw your attention to the Telegram that we have for everyone to subscribe. And that's both in English and in Russian. There is a lot of information on like signals and indicators, what to buy, when to buy, and both in shares and options markets. So please do subscribe. And right now I would like to invite and start our Friday investment talk. And I'm gonna give.
Yeah, I took the screen, Ron. I took the screen.
That's why I'm like.
Yeah, yeah. I took it. I wanted to just show the some of these things that we posted in on the Telegram channel. So we covered last week that there was this increase in retail investors, and this week I just wanted to highlight that really important. Like, if there more, the markets are hitting all-time highs here, so. You know, I just want, this is pretty incredible today with the jobs report out in the United States that the NASDAQ is now breaking out to a new record high. You know, Apple also breaking out to a new record high today. So all of this bullish, how can the markets be so bullish when, you know, the world is in the depths of a recession? I mean, okay, you know, there's 13.5% unemployment in the United States. In other places it's much higher than that. And you know, how can there be such a rebound in the markets to think that everything's going to be so wonderful? Well, one of the things that's fueling this fire, I think, is the, you know, there's huge amount of money that was sucked out of the market when the market fell, and it went into bank accounts, and it went into cash equivalent investments. So not even, it went into money market funds, not even in bonds or anything like that, but it went out of everything and into cash. And you can see now the cash levels, how high they are compared to, this is in institutional and retail money funds, as a percentage of the US market itself. You're at where, you know, the highest before it was at between 10 and 12%. This is now at 16%. So cash levels are extremely high. This is extremely bullish for long-term, for the markets, for stock markets, long-term bond markets, and you're seeing any kind of this. They got this new saying. There was FOMO, the fear of missing out, and now there's this TINA, and TINA I think stands for.
There's no alternative, Chris.
Yeah, there's no alternative. Exactly, there's no alternative. So they they make up these little phrases that basically, when you have your money in cash and you're looking at how the market's doing, you're going to throw your money into the markets kind of headlong. So we talked about the job rate coming out this morning, really much better than they forecasted. We posted late last night that the forecast was for losses of between 11 million and 3.5 million in May, and they actually came out with 2.5, I think, or million that actually were added. So this was way off. The analysts had it all wrong, and the market's up, I think, 2.5% this morning. So yeah, follow along on this. This has got a lot of not only macroeconomic ideas, but got a lot of stuff in here about specific trades. So unfortunately, it's in Russian. It can be pretty easily translated, though. If there's stuff on the graphs, sometimes I write on the graphs in English, so you should be able to get some interesting ideas off of this. I wanted to just go back a little bit to what Vron was saying, that we did this dividend ETF presentation, and I translated it back into Russian, from Russian into English, and basically the ETFs. So there's a lot of ETFs. When people throw around the word ETF, they think of ETFs, dividend ETFs. They think specifically of ETFs that have the word dividend in them, right? But the real high-paying dividend ETFs, or even ETFs that pay dividends, are not necessarily even those with the name dividend in them. And those are things we've talked about in the past: MLPs and country-specific country funds, and now preferred stock portfolio. So what's really working right now is this MLPs, and I just wanted to show some of these, because the gas prices is normalized. It's back up. I think WTI is above 35 now, so you have a lot of interest in these really oversold assets coming back to life. These pay huge dividends, above 10%, and there's a lot of momentum behind these right now. And we just did a little webinar and showed how to find these and get some information. So I'll make that presentation available to you guys in English, and you'll have that to go through with clients. I wanted to bring up real quick a service that we use. Is NASDAQ Dorsey Wright. It's like a momentum screener, and it shows you where things are really working and when they're not working. And basically what's working right now is, in terms of fixed income, is preferred and convertible shares. Convertible bonds have been going through the roof right now. US high yield, and that's kind of a bright spot because that's also correlated high with equity markets. Large cap growth and mid cap growth, but the cap weighted ones, in other words, don't go to equal weight, because equal weight is underperforming. As I said before, energy's making a revival. Technology has been strong and stays strong, but it is falling a little bit here. And I'm going to bring up something of which sector of the technology we need to be careful about. And I think there was some questions we were talking about earlier this week with the US dollar and the euro, and I just wanted to bring that up because that's always important for our clients. This is really, the dollar has fallen off a cliff against all currencies, especially the US, especially the euro. You can see that here. It shows that the euro has grown against the dollar, and this is really kind of an extreme situation we see, where there's been a lack of faith in the economic situation in the United States, with constantly pumping money into the economy, whereas Eurozone up until yesterday was pretty much well, let's put it this way. In American terms, it was behind the curve, but in the euro terms, they were very stringent in how they were spending their money. So we'll see if this turns around as as the Eurozone kind of says, okay, we need to also stimulate the economy to get people back to work and get the economy going again. But this is kind of an extreme situation here. And then I wanted to bring up that point just to finish up my point, my part here. I just wanted to bring up this point about the stocks that are kind of really, and we wrote about this. I can't remember if we wrote about it in a blog or no, we wrote about it in a blog in English about this transition from the tech sector, maybe industrials and transports is going to be the new leadership coming forward here. But let's look at like the software sector. So the software sector has really gotten ahead of itself here, I think, in terms of valuations, where you see these SaaS, and I think we talked about this last week with software as a service. So basically, these companies like Docu, and which is DocuSign, and what are some other ones? Smartsheet. You know, these companies were going crazy because, you know, these are companies that basically recurring revenue every month or every week, and it's basically the stay-home economy supports the fact that you just sign up for something online and it takes care of either your billing or your signing of the documents or whatever. They have distance learning. Zoom was part of this. So you have all these companies. Well, these companies are now posting huge churn rates. In other words, they brought on all these 9 new clients. The clients are beginning to drop off, and their guidance has been reduced. And you've seen this company was down 21% after earnings. There was another company out that came out last night after earnings, and also was down strong. And I'm trying to find the ticker on that.
I think while you're still looking for the ticker, Chris, I mean, Zoom this week came out with their earnings, and they're valued at $57 billion.
Right.
And
so the valuations are extreme on this. This DocuSign was at $27 billion or something, and they have a $300 million revenue.
Right. But if you do like we're using Zoom, but with my clients, and I think I mean everyone's got different clients that they deal with. I have 3 or 4 clients, or 3 or 4 different Zoom competitors that our clients are using. And I don't see the barrier to entry for this industry. It's not a high barrier, and it's very butterfly-like. You know, clients will migrate from one, and then
that's the churn. That's the churn rate. Exactly. They're saying like you're going to bring on a lot of clients, and then when they don't need their service anymore, those clients are gone.
I mean, Zoom at $57 billion just seems bonkers.
Shopify is another one, and there was some other ones I just brought up, Twilio and some of these. And we brought up an article, and I can bring. Yeah. Well, anyways, if you look back in the last bit, you'll see this article where these are selling at 20 to 25 times sales. Not times earnings, times sales.
Wow, it's all about futures, right?
Yeah, and 20 and 25 times the sales back in 2019 when the market was in an absolute boom. They were selling at 7 times sales. So this is like, you know, these people are really, there's a lot of hopes going. When you see churn rates increase or guidance not being propelled forward, or I mean, a lot of these companies are still earning. The earnings are negative.
This part of the tech market is not enough to bring down NASDAQ itself as an index, because
they're not large companies, right? They're not large companies, but
it's the FANG stocks you got to work out. They're the ones that move the index, not only the NASDAQ index, but basically every index in every market around the world.
So it's Amazon, Apple I just showed, and it's we can even include Netflix in there, but this is a potentially problem with churn. They even mentioned it in their earnings, the last earnings. We have no kind of guidance about how this is going to be, and we don't expect our numbers to increase more than they did. So that's why they kind of after earnings just kind of consolidated. But the run up into earnings was huge. Like you mentioned Zoom, but the big ones are Apple, Amazon, Cisco. These companies like are in the NASDAQ, and we've written quite a bit about those things. So be careful about the tech. We're looking, and just in general about the markets. The markets are bullish. They're going up crazy. I mean, their NASDAQ hit a new all-time high today. So we have to be careful of what we're in. Mike, did you want to bring up some tickers that you're looking at, or your clients are in, or you want to? I mean, you had a lot of stuff.
Couple of things that reflect what you've been talking about is that what clients are doing now is we're seeing rotation away from tech reflected in the NASDAQ. So if you look, I don't know if you've got some of those tickers, but ARKG has been a very popular genomic, ARC Genomic has had an amazing period since the middle of March, but now as the signal as the economies have opened up has been that tailing off. How much a correction there's going to be in there, I don't know. I would have said until we saw today's jobless figures, we were right on the cusp of worrying about a reversal, and now I'm not so sure.
Right.
But look in contrast at XAR. XAR is aerospace and defense.
Yeah. Actually, this has been a hot sector. We mentioned this last time, Martin, and specific tickers in this, like
you can look at
RTX.
Yeah, you can look at ITA as well, Chris.
Yeah, Lockheed Martin and
VA is the other
Northrop Grumman, right? So this is a hot sector, especially if there's going to be a flare up with China, and we saw last week with the Hong Kong issue. There's been a lot of growth in these types of shares. I, personally like this stock. Broke out today big time, and this is Raytheon. I mean, this is a defense company, and it's still in beaten up levels here, and so you can see this can go quite far back. I wanted to mention on that note that there was an article about this ETF jets and how this small this is an airlines and transport, basically airlines, and there's been a lot of like speculative trading from these retail traders that started going crazy with options in this jets ETF. So you're seeing a lot of in these jumpy moves where there's a lot of gaps in these ETFs and stuff on a trading. You're seeing a lot of short-term, even weekly trading in this stuff. Day trading, but the maximum they're going to go out and buy an option that expires on a Friday, they'll buy it on a Wednesday. So it's extremely. There's levels of froth in this market that are definitely there. There's a lot of people at home gambling in the markets, and this is kind of one of those things. So we have to be
By the way, casinos are opened yesterday, since yesterday in Las Vegas.
Yeah, I saw they went back, and there was kind of some.
Are they online? Because if people are people going to travel to Las Vegas? They can be open, but will anyone come?
So this stock here is an online gaming stock, GAN. There's another one, DKNG, I think it's called. These have been huge plays recently. I mean, basically, they even cover them on mainstream news in America about how everybody's just going to sit at home and gaming. SPCL or something is another one. So I didn't really cover these as they're quite speculative names, but these were huge names, huge kind of speculative, frothy type of trading and anything that was online gaming, these are new companies actually. This company just announced it was going to do online gaming, and it shot up from $2.50 to $12.50 overnight. So these are kind of crazy times. But yeah, there's been an increase a lot in the online world. One of the things we did touch on too, Mike, did you want to bring up some other symbols that you were looking at?
Let's look at some commodities. I think it's been interesting to see what's happened or really not happened.
Right. One of the ones I think is interesting is natural gas, and I published this highway to the danger zone here that natural gas prices are a record-breaking drop among made a huge supply gut, right? So this is a potential. This is something that hasn't seen the light of day in years, right? So this is a problem. But if things do come up where the economies come back online, and this would be like one of the interesting places that hasn't seen a rebound yet. So we're going to keep an eye on natural gas. But
it's also the major export of the country in which most of our clients, I think.
Right. I mean, everybody's watching that, and if you go onto Telegram on some of these Russian channels, they talk all of. I mean, it's brutal. It's like this price on oil, this price on gas. Every 15 minutes, they're talking about something. There's a calamity out in Siberia now, Norilsk, and they talk about that all the time. And so. I did want to, that reminds me, I wanted to bring up one thing, Mike. Let me just real quick, see if I can find it. So Morgan Stanley was out yesterday with this new, where could jobs be, where could unemployed be put back to work? And they're going to come up, there's this new idea of this Invest Act in America, right? That's going to authorize highway spending, infrastructure bill. They're talking $500 billion as a minimum, right, over 5 years. But there's numbers more like 750 billion to $1 trillion. This will be coming into before the election. I mean, Trump wants a stamp on this, so and there's some other bills that are coming offline in September, so they want to give this big stimulus package. So this is interesting, and on this news you could see building stocks or building material stocks really kind of spike yesterday. So again, along the commodity theme, you had companies that like kind of associated with it. One would be this U.S. Concrete, USCR, starting to really rocket here. But there's also Vulcan Materials and some other companies. Let me see if I can, VMC. This is the biggest company probably. Again, on this news, starting to rocket here. They have room to run to where they were previously. So there's this, XLB is the ticker for the sector as a whole, the ETF. And it's already, look, it's already back up to levels that were, you know, before the crisis. And this is kind of, again, you know, there's hope that the government's going to pour money into the economy, that it's going to do it through these increased spending bills, these new spending bills, these new investment acts. And I can make this you guys have access to this this Morgan Stanley report, but basically this idea is these are places that are getting attention right now. What else were you looking at, Mike, real quick, if we can some stuff?
Palladium was of interest to a number of people.
Palladium, yeah.
Because of the combustion engine's place in the resurgence of a socially distanced traveling populace. Basically,
right.
People are getting cars and motorbikes, and the supply of electric vehicles and modern, you know, eco vehicles is not there yet. So are we going to see an uptick in palladium by the end of the year?
Yeah, and here the caveat with this, I think, is that you need to see car production increase, right? Or because there's a lot right now of, I mean, Hertz car rental went under. They expect 500,000 cars on the market in the secondary market. There's a lot of pressure right now on secondhand car prices in the United States, and then there's volumes of cars that haven't been delivered even to the ports. There was tankers in Los Angeles of Nissan cars just floating around in the ocean because they couldn't even bring them to port. So I think it might be a while before you know, you see an uptick in increase in production of cars. But yeah, that looks like an interesting play. Definitely from a technical point of view, you've got this nice area here of consolidation, and hopefully it can start moving from here. But was there something? Oh, we should cover. We should cover healthcare, right? You mentioned originally that there was possibly, now that people are going back to work, that there's not such a threat. I heard out that AstraZeneca was supposed to come out with a vaccine maybe this fall for the coronavirus. The play on biotech and healthcare may be a little bit. Well, we'll see. I mean, we'll see what happens, but there might be some downside risk to this, I think. And so
I haven't seen specific tickers on this, but I've looked at a couple of stocks. AstraZeneca and Nordisk have been the sort of go-to stocks for health, and both of them seem to have seen pullbacks.
Yeah, and I think that as the economy, this is kind of almost inverse, but as the economy does better, these stocks might run up against some problem. Gilead was supposed to come up with, they had this drug and whatever, but this recent action, this recent bullish action in Gilead is because they have a rheumatoid arthritis drug that's actually been approved. So it has nothing to do with coronavirus anymore. And some of this other stuff, like this one we used to like, this, well, I can't remember the name of it. But Moderna or whatever, these vaccine drugs, if they may not, there's going to be competition between them, and there might not be any real need for these for the hype that's around them anymore. I've got some smaller tickets, but a lot of this stuff you can read. We wrote about, there was a buy signal in the Chinese internet sector yesterday that some distance learning companies, and I like to publish stuff about the construction there. So there's some interesting stuff that we write about every day, actually, in Telegram. And if people follow that, then I'm sure you guys do, Mike. I know you do for sure. So, well,
you want to touch on at all on where we are on put call ratios at the end of the week, moving?
Yeah. So let me see here. Let me bring out the file. Oh yeah, boom! I had that ready, Mike. So yeah, we're overbought, extremely overbought in terms of the equity only put call ratios, right? But that doesn't mean that there's sells, and there's a sell signal yet, and we're waiting. We'd have to wait for a sell signal to come. So just because things are overbought doesn't mean sell. And you know, a lot of, I mean, we had a webinar on Wednesday, was it right, Ron, with for the dividends, and some of the questions were directly, you know, I listened to this advisor and he told me to sell everything, and I'm like, I don't know, based on what did he tell you to sell everything? Why are they raising cash? If you raise cash and just because you think things are overbought, you just missed 2.5% in the market today. I mean, like, there's no reason right now to raise cash. There will be a reason, and there could be a real big reason soon when this thing rolls over. But we're going to watch for that. We watch it kind of. These charts come out weekly, but there's a daily update twice a day. So we kind of watching this, and
what
we're not there yet.
On that, what effect on that put call ratio is this large influx of gamblers stroke new retail clients? What effect could that skew the figures somewhat?
So what's happening, you're seeing that's a great point, Alan. So here's what the difference between these two, right? This one's extremely overbought, right? Entering levels hasn't seen since 2011. And this one's not that overbought, but getting there, right? So this is the equity only, and this is the weighted equity only. And this is what the difference between these is the people that are buying out of the money, far out of the money calls. And so this takes the volume of those calls being traded not on a dollar basis, but in a numbers basis. And so we see a lot more people buying far out of the money calls, right? They're really cheap. And that's the retail, that's the gamblers, right? They're putting that money in, and they're really doing it on short-term, far out of the money calls, just to hope that, you know, those calls move up in price in the next, I don't know, day and a half or less, and then they sell those. But when you weight them on a dollar basis, they don't have a big effect on the market. So the real traders, the real longer term traders, the professional traders, you don't see that overbought sign yet, okay? And so the frothiness is caught in here. The lack of froth in the real institutional money is not there yet, and therefore we see, I mean, basically you see this potential for this to go, the markets to go higher. And that's a kind of key thing that you can pick up on is the difference between the dollar weighted and the non-weighted call buying. But that's kind of technical. We didn't need to really go into that now, but that's a good question. Yeah. So we're waiting for these things to turn around. We're waiting for the breadth is really positive now. The VIX has come way down and is starting to break below its 200-day moving average. Very positive long-term for the market. We mentioned that there's on our blog, it was a positive thing for the market recently for a 6 to 9 month period where the extremely overbought situation in terms of the broad number of shares being bought, and the lack of 52-week lows in the market and stuff like this. So technically the market is very bullish. And I think we showed just now NASDAQ being bullish. S&P can come back quite a ways, but this is a big candle today. I mean, look at this. This is a big move above this previous place that it failed, and the futures are easily, I could say on a technical basis, if we didn't know we were in the middle of a massive recession, you'd think, okay, this is going to go back to new all-time highs too. So, you know.
What would you say, Chris? There are some clients who were in cash or chose to stay in cash because nobody really saw the extent of the acuteness of the angle of this upside. So we're waiting for a bit, VIX to be lower and expecting everything to be a bit smoother, and now still sitting in cash have missed
a lot of this.
A lot of this. What should they do now? come in or stay waiting for this to
So Mike, the thing is, this can go, being overbought is a good sign until you're not overbought, right? But as long as you stay, as long as the market stays overbought and can continue for a year, like literally, I've seen it. Like back in 2011, it continued for a long time. And if you look at this write-up, he expresses the fact that, like, you can see this thing went up. The market gave a sell signal somewhat here, but the market continued much higher before it turned around. And that's because the market has to, besides the put-call ratios or other signals, the market has to kind of respond to with some negative action, right? And so I don't see coming off a day like today that all sudden things are going to be awful tomorrow. I mean, there's a lot of money, and I think I tried to highlight that. There's a lot of money in the reserves in the banks that can fuel a huge rally from here. One thing you have to do with all your clients, though, is we have to always make sure that we're conscientious of which sectors are extremely overvalued, and that would be IGV, the software sector, and maybe some certain areas beyond that in technology, right? But so you might have to be a little bit more selective, not just like broad market indexes, but be selective and look for where things are transitioning to maybe new leadership. XLI is still really interesting. Even though we kind of focused on it back here, this is these are industrial companies that put people back to work, and demand goes up, and this would follow through. XLB, we talked about, the XLB already is reaching the limits here. You wonder how much more this can go, but I mean, there's a lot of stuff outside the tech sector that is interesting. I do expect, though, even if the market does pause here, it's likely just to pause and not maybe crash. So, we're headed into the summer months. The summer months can be kind of more volatile. There's less activity. So if we get some pullbacks in certain things, then there's good opportunities to kind of make new entries in the summer months. So it's not like all lost right now. You got to rush in because Friday's up on after a great jobs report. Let's see what happens next week. Let's see if there's some better entries, What would you have to comment, Ron?
Yeah, can we look at, that's the regular question we get asked about, is HYG and LQDs, this high yield corporate bonds and investment grade corporate bonds. And those were interested for most clients because they went from underlying assets from the regular bonds into actually ETF bonds, because even before Fed Reserve announced buying those ETFs, they already been trading 160,000 times a day, and that's more than any of their underlying holdings. And right now, investors trying to stay away, and institutional investors trying to stay away from underlying holdings, especially if we look at the high yield defaults by sector. And I don't know if you could bring up this chart.
Did we talk about that last time? Do you guys remember if we talked about the?
Don't think we did.
I don't think.
Yeah. And I can just pull it up if.
Yeah, here it is. Here it is. Yeah. So it's like Ron's referring to this chart we have where the U.S. high yield defaults by sector. You see a huge number of default. Well, these aren't huge numbers. There's eight defaults in the
but in
energy
face
sector.
Value, they're
but in value,
higher.
yeah, these are much larger. So versus the same period last year, we're up 3 times in terms of the dollar value in defaults, but only double in terms of the actual entities that defaulted. But the big sector here is energy, and I think Ron, we heard this before. Like, they get out of the actual energy bonds because they're risk, and they go into an ETF, right?
Yes, and telecommunications, it's even worse. But they go, they follow institutional investors. They go after LQDs and HYGs. Right.
So HYG is the high yield. LQD, we mentioned this way back, I think with Mike too. We talked with you about the LQD. You know, what happens when these liquid corporate bonds, these are like AA rated bonds and better, you know, high liquidity in the market. They're easy to trade. When these things fall from 130 price to a 105, you know, and basically this was the idea was the U.S. government, if they're going to buy anything, are going to buy these bonds, because these should. This is a structural problem in the economy when people can't have any kind of certainty, or they don't feel secure in the most secure securities, right? So we expected this to come back to reach all-time high rather quickly, and it did. It didn't take, you know, the whole month of May. It rebounded quite quickly. And there was a bit of a problem here when interest rates started rising again, but they're back at basically the levels they were before. And so this is the kind of gold standard for bond investing. And HYG has a ways to catch up, because it is still littered with potentially defaulting companies, from Hertz to energy groups to communications companies and stuff like that.
There's a very interesting space in between, the so-called fallen angels space. If you have a look at Wing, W-I-N-G.
Mm-hmm. Right. No, not Wing. It's Angel, isn't it?
Or H-Y-F-A or A-N-G. Yeah.
Yeah. So yeah, this is fallen angels, right?
Yeah. That's right.
Yeah. Yeah. Fallen angel ETF. Hi. Yeah. Mm-hmm. So you're gonna see. You're going to see if you can get specific, and that's a good, just goes back to what we just talked about. Get specific in areas that make sense to be in. There's also some dividend ETFs that are like the gold standard of dividend ETFs, and then they've fallen off a cliff, and there's still a good 20% or something until they get back to their normal level. So yeah, I would look at this. It's undervalued, deep value ETF. I don't remember the name of it, but and this we pointed out in the blog that there's a transition here between these high growth SaaS kind of software names to a more value oriented focus in the market, and institutions are going to be chomping at the bit to get into something that generates good cash flow and offers a good yield still. So, okay. Anybody have any other things they wanted to cover? We heard from everybody today, which was good.
We're probably oversold or overbought on people's time at the moment, but
yeah,
a list of things to go through.
Yeah. Okay. Well, anyways, we have a lot to talk about always, so it's good to see everybody, and we'll wait till next week and go over things again, see how the market's doing then. So thanks a lot, everybody. And
thanks, Chris. Thanks, Veronica.
Thank you. Thank you, everyone.
Yeah.
Have a good weekend.